Hi, my name is Jessica, and this is our Case 2 study presentation for PacketUp using CVP analysis. PacketUp is a new package delivery service company owned by Gloria Wallstrom, and they operate in a major metropolitan area due to the increase in demand of package deliveries and use of electronic commerce. Gloria is debating whether she should go for alternative 1, which would require her to contract with delivery personnel, meaning they will use their own vehicles for transportation. With that being said, they will be paid on a commission basis. Alternative 2 would require Gloria to provide her own fleet of delivery trucks, and by doing so, she will pay the personnel a fixed salary per year, which would result in higher fixed costs in comparison to alternative 1. After taking a closer look into the data, we decided it would be best for Gloria to follow through with alternative 1 because it is a more secure and low-risk investment. The break-even point indicates the level of activity at which total revenue equals total costs. At this point, the contribution margin equals fixed costs. With that being said, the net income for both options is 0 at this point. For alternative 1, the break-even unit is 28,107 deliveries per year, and the break-even in dollars is 2,670,165. For alternative 2, the break-even unit is 64,576 deliveries per year, and the break-even in dollars is 6,134,720. As stated earlier, at these points, PacketUp will realize no income and suffer no loss.
The margin of safety analysis refers to the difference between actual sales and break-even sales. Gloria's best approach to this decision would be to identify the point where her sales are contributing to the overall profitability of the company. PacketUp's alternative 1 option would be more cost-effective in the long run, as they would require delivery drivers themselves to provide a mode of transportation, and cutting down on the company's fixed costs. Gloria's margin of safety ratio for alternative 1 comes in at 53.16%, showing that in the long term she would be more profitable, and it also shows that the company can be financially sustainable in the long run.
If Gloria indicates that she is not contemplating the PacketUp business venture with the objective of just breaking even, she can set a target net income. In this case, Gloria wants to generate a pre-tax profit of $25,000 per year. For alternative 1, PacketUp will need to make 29,000 deliveries to achieve this goal. For alternative 2, PacketUp will need to make at least 65,000 deliveries to achieve the desired profit.
In Gloria's PacketUp CVP income statement for the year ending in April 30th, 2021, in her first cost structure alternative, if she gets sales and subtracts them from variable costs, she will get her contribution margin, which is $2,755,000 minus $1,943,000, which will equal $812,000. If you get that number and subtract it from fixed costs, which is $787,000, you'll get a net income of $25,000.
Continuing with the CVP income statement, Gloria's second alternative is a bit more costly than alternative 1. Gloria's contribution margin is acquired by subtracting the total sales made by the variable costs, which totals to $3,835,000. You then take the contribution margin and subtract it by fixed costs, and you will acquire the net income, which is $25,000. As you can see, Gloria is spending a lot more in alternative 2 than she is in alternative 1. And in the end, the net income is the same in both alternatives. The degree of operating leverage measures how much of the operating income of a company can change when a change in sales happens, whether high or low. In Gloria's case, alternative 1 has a lower degree at 32.48%, which means a company with low operating leverage has a large proportion of variable costs, which means that it earns a smaller profit on each sale, but does not have to increase sales as much as to cover its lower fixed costs. Alternative 2 has a degree at 153.4%, which indicates that a company with high operating leverage has a large proportion of fixed costs, meaning a big increase in sales can lead to outsized changes in profits.
For a 10% decrease in sales, both cost structure alternatives are pretty similar in the beginning, with a current price of $95 each. Then you would multiply that by 0.10 to get a $9.50 decrease in sales for both alternatives. The new selling price would be $85.50 in sales. You subtract that from the VARS, which is the value at risk, which is $67 for alternative 1 and $36 for alternative 2. The new contribution margin for alternative 1 would be $18.50, which you divide by 787,000 to get 42,541 BE. For alternative 2, you would divide 49.50 from 3,810,000 to get 76,970 BE.
Clearly, Gloria can choose either alternative 1 or 2. However, we advise her to invest in alternative 1 because there are lower risks associated to it. This can be seen in the margin of safety analysis for alternative 1. It was clear to see that the margin of safety ratio for alternative 1 was greater than the ratio for alternative 2. We also assessed the risk while calculating the degree of operating leverage. The operating leverage for alternative 1 was less than the operating leverage of alternative 2. This is not surprising because alternative 2 has higher fixed costs. We understand that Gloria could go for alternative 2 because her profits will increase rapidly. However, we advise her to not go with alternative 2 because if her sales decline, she will have devastating consequences, which is problematic because this is a new company. With that being said, alternative 1 is less risky and better for the financial well-being of Pack It Up. Thank you.